All right. Well, welcome everybody. Good morning, good evening, good afternoon, wherever you are in the world. Welcome to the monthly webinar. My name is Lea Peters, and some of you know me. So I am the owner of FX University. We trade primarily currency spot. We also trade and analyze gold. We follow the equity markets as well. So today we are going to be talking about the price being the king, and how we can profit from understanding the price movements and what really drives the price of different currency pairs. In the beginning of I do not take much time to introduce myself and whatnot. If you would like more information, you can go to the site. We have a lot of material to cover, and just 10 minutes less than we originally planned. So, in the beginning of the webinar, I would like to present you with the structure of the class, of this particular webinar, of this tutorial, and how we are going to break it up into segments and follow through with those segments. Before we actually get into examples, we will go and verify that what we are talking about, the price in relation to the moving average and the price in relation to its own history, is really very, very meaningful for us. However, we have to take it a step back and really also understand what drives prices. And without synergy of all of these factors, plus, of course, the money management, right, you will not be able to succeed as a long-term trader. However, in our trading room, I teach everybody to just totally forget the statistics of the failure and just concentrate on learning how to trade, in this case, Forex markets. All right, so the structure of today's webinar will be, we are going to talk about the Forex trading in general, combining what kind of analysis you should try to apply while trading, combining it with, again, the price in relation to the averages in history, combining it with the money management. We're going to talk about fundamental and technical. We're going to define the price. We're going to define a moving average. All right, and we are going to put it all together, and hopefully by the time this webinar is done, everybody could see a little bit of a different picture of how to proceed and trade actually Forex by zooming out, understanding bigger picture, and then zooming right back in and being able to apply it to intraday swing position in practicality. So that's what we're going to do. Then, from presentation to presentation, as I finish this thought or a part of the discussion, I will look over to the chat and see if there are any questions for me to answer, because questions are welcome. I encourage you guys to ask questions, and I will do the best. I'll try to do to the best of my ability to answer them in a timely manner. All right, so we're good to go. Okay. Agreed? All right. So first of all, I would like to bring up the Euro-Pound daily chart, and this is a simple chart. I quickly would like to overview what it has on it. All right, it looks almost like kindergarten, right? Girly colors. But anyways, as long as they work. So what we have are two moving averages that, again, we're going to define what a moving average is. And one of the moving averages is a part of a standard indicator created by John Bollinger to define the volatility in the price disbursement above and below it. And it defaults on MA20. We know it as Bollinger Band. Right? We also have 9 here. We have the envelopes, 1% envelopes above and below moving average 9 that are statistical 1% deviation. I also have a stochastic 3533. Whichever oscillator you're using, they're all going to be lagging the price itself, so it doesn't really matter whichever one you like, whether it's RSI, CCI, percentage Williams R. In this case, I have stochastics. And one of my favorites is 233, and the only one I'm missing here is 312. We'll put it on. Moving average 233 exponential in this case. So now that I have defined what we have on this chart, so let's zoom a little bit back, and we will look at a trend beginning right here as it was in October of 2008 after a sideways market. Before we get into technicals, I would like to bring your attention just the last class, and some of you might have been in my last class, which was just last Tuesday. We talked about the fundamentals, right? And so this is Euro Pound, by the way, Euro Pound. If I didn't mention Euro Pound, right? We were talking about the fundamentals, and fundamentally, the euro dollar was in much more of a demand at that time versus the cable. European community was growing by leaps and bounds. The Eastern European community started joining the union, and so it translated on our technicals. And, you know, this is just a simple way to put it, right? Simple way to put it. So, taking a step back, we would say then, we need to understand the economics of the countries of currencies that we trade. We need to have a comprehensive knowledge of what is going on in the world, being forex traders. Right, so we absolutely cannot ignore fundamental analysis. However, the challenge of the retail forex traders is that we do not get the fundamental data access all at the same time. Alright, the information gets to us after a while. Economic conditions change, and then it translates later. The markets, being highly speculative in nature, they lag, and they react a bit later. They lag the factors themselves, unless, of course, you are trading all those whipsaws, the greed and the panic during, let's say, interest rate, employment release, or trade balance, or GDP, or housing, right? We'll go into that too, what happens with the price. And really, momentarily, fundamentals are too subjectively interpreted for us to trade. Alright, but in the long term, the exploding growth of the European economy in itself, and the flexibility in the monetary policy of the ECB versus the BOE, which held off for a while, cutting rates and whatnot. So here translated in Euro Pound uptrend. So we have just put together and testified to the factor that in order for us to trade technical indicators that we're going to talk about, which is moving averages and the price in relation to them, we also have to understand the fundamentals. Okay, second piece to the puzzle, this big puzzle of forex trading, in my opinion, is that forex trading and leveraging is a very risky business. And there is no holy grail in any system, whether it's technical or fundamental system, absolutely nowhere found out there. And if anybody gives you as a trader any guarantees, then, and if anybody makes you any guarantees, they really should stop trading. There is no guarantees in this business. However, there are some systems used by technicians where traditionally they use the moving averages, Whether they're simple, exponential, or smooth, it doesn't matter. Okay, so what is the moving average? A moving average, obviously, for us, is a technical indicator. And what it does is it shows the average value of the currency pair we are trading over previously determined period of time. So obviously 20 is 20 periods of a time frame that you are trading. There are a lot of mathematical variations of moving averages. We in our room for intraday trading like to use Fibonacci numbers, 3, 5, 8, 13, 34, 62 for our moving averages. Okay, and no matter what averages you're applying, they are all attempting to do the same thing. Okay, you're trying to predict patterns in the currency movements that will allow you to enter or leave the position at the most profitable time at a trend shift, right? So exactly, that's all we're trying to do. We're trying to predict the patterns of the movements that could allow us as traders enter or leave or exit the position at the most profitable time before the trend shifts. All right, that's easy said than done. Okay. So if we have just now we have done and finished the definition basically of the average itself, but we're talking about the price being the king. But literally, what drives those prices? How can we understand the order flow? Where basically, one of the biggest challenges for Forex traders is to interpret the price action without really seeing the order flow. So that's very, very difficult. And if we say the price is the king, and if we say the trend is your friend until it changes, but then also what drives the price? When is it going to change, right? And really, if the trend is your friend, but it's only there for 20% statistically out of the time, how good of a friend is it? All right, and so I think I've just a little bit more confused everybody. No, but if you think about it, in reality, that really is true. All right, so let's zoom in. I am zoomed out right here on October. So I am zoomed out here on Euro Pound. We're saying we are understanding fundamentals here. The technicals are such. We're going to start zooming in, and it's going to be easier for you guys to see the price action too. But the reason why I zoomed out is to bring everybody's attention to another universal truth in markets and whatever financial instrument you trade. The fact is, the markets alternate between the sideways markets and trending markets, right? We know that. That's not a secret. So, but however, if I closed out the time frame that I'm talking about and didn't let you know that was the daily, would you know actually what time frame it is? You'd be asking me, what time frame is it, right? And so here's your other universal truth, that markets move the same way, the same fashion, no matter what time frame you trade. So here comes your choice, right? You can be successfully trading intraday markets just by understanding the price in relation to the average, also that the sideways market is going to end at one time and the market is going to break. And when it breaks, what you would need to see then, where is the price itself in relation to its own average to put more odds in your favor as a trader to initiate a position. So if I'm going to see here too that we were in a channel for the longest time, sideways markets right here. And then let's say I put 50% of this channel. Once I drew 50% of this channel, The initial breakout was on the upside, only then to break below symmetrically. I'm not saying anything. I'm not throwing the numbers at all here. Right now, at this particular moment, I'm not even talking about the trend or the lack of such or breakout. Right now, I'm talking about understanding that markets are symmetrical. And the symmetry and the simple mathematics of it will also help you trade it successfully. Okay, that's the next point. As soon as we break out and repeat pretty much the value that was above 50% of our sideways market breakout, repeat itself on the downside, and then find a longer-term moving average as the support and start taking off. This is your time to start looking at initiating longer-term positions, carry positions that you can hold on to. First of all, we're talking right now about the fundamentals behind this pair, euro, being so actively and aggressively bought against the cable. Secondly, we saw that the sideways market was about to come into a breakout. Thirdly, we understand the symmetry of the market as well, and the initial breakout being on the upside being repeated on the downside. However, here we come a little bit closer to our topic today, right? But I had to lead to it first. 233, longer-term moving average. The longer-term DMA, obviously, it predetermines a longer time period of averaged value. So we came down, used it as support, bounced off of it, understanding the fundamentals. We're ready for a trend. We are ready for a trend. Now I would like to zoom in and go and take a look at the price in relation to shorter moving averages, right? Okay, before I do that, we also have here, as I said, as I introduced as soon as we started our webinar, standard indicator Bollinger Band 20. And we said that this is basically very widely used indicator that determines the price volatility and the disbursement based on the price volatility, disbursement of the prices 2% above and 2% below of the moving average 20 in this case. It's not to say that you cannot vary, like I said, you could use any other default setting on the Bollinger Band. Alright, now that we have done that, also determined, put the definition on the Bollinger Band, now let's zoom in a bit and talk about the price and how we can enter into positions, alright, and what certain patterns in the bars and day closes in regards to the averages themselves, what all of this brought us into a position. So before I do that, are there any questions? Okay. No, everything is okay. So I see okay. Okay, thank you. Alright, we were talking about Euro-Pound, looking for combining our fundamental knowledge, our technicals, and, okay, where do we enter? On Tuesday, we are viewing this as a bullish divergence. A bit of a lower price after initial breakout in the upside, a bit of a lower price, and on the stochastic, a bit of a higher reading, coming up from back below 20, crossing back up and closing back above 20. Now, we have determined that any oscillator, as anything else, is secondary to the price itself. It's going to follow. We also have to remember what we have said, what drives the price, right? Now, based on this new swing low, which is a bit lower than the previous one, we are not going to know that this guy is in place until the next day closes. Because we're not going to know until the close what low it establishes. So until this day, we don't even have the divergence. Once this trading day is complete, once this trading day is complete, we can start looking at possibly the discrepancy between the price, lower price, and higher oscillator, which what a divergence is. We look for convergences most of the time, right? Like when we use the fibs, we're looking at support and resistances to come in and to play with the fib levels. And that's a convergence, agreement, a confluence. In a divergence, we look at a discrepancy, a divergence, meaning what this means here is there is no more sellers to sell at this price. This is the area of demand. This is where demand starts, technically, whatever, fundamentally, both. And so the price is starting to go. First of all, we also, by the pattern of the bar itself, on the daily, we like to use the bars because the bar formations, open, highs, lows, and closes tell us a lot. It was a down day, but look at the close. Okay, so down day with an up close, is it a bullish pattern or is it a bearish pattern? Can anybody tell me? A down day with an up close. Bullish, thank you. Yes, absolutely. So now, on the close of this day, not only do we have a divergence saying no more sellers here, right? We also have a bullish pattern here and a bullish pattern here, and the price approaches, it's still below MA20, but it approaches moving average 20 and closes right on the shorter MA, which in this case is moving average 9. We failed to break to the upside already one time, right? So do we automatically, until we close back above or at least hit MA20, we're not going to go long, right, until the price hits this level, a longer-term, more stable trend. Because if we're trying to catch a falling knife here, we're going to lose out on it. Until, again, we come in and read this MA and we start initiating tiny, I always say start small and rather build. I know, build into your position. I know as per FIFO rules and whatnot, it's going to be practically impossible to build, but I understand that a lot of brokers are now offering offshore accounts where you're not going to be affected by the new CFTC rule, and so you'd be able to build into position. That's one of the biggest aspects of becoming long-term successful is start out small. The trends do not change in the blink of an eye. So you're going to initiate, this day is your signal, you're going to put your cross here at what is your moving average 20 reading. And really the price is too close to it. And you know why? Because we're coming basically out of the sideways market. If we were in the straight downfall, this bar here would be quite below the MA20. Alright? So, but nevertheless, we initiate a small long position. Can we add on the close of this day, based on the knowledge that we're actually talking about right now, right? That the price is higher than its own average now, not only on the shorter MA and May 9, but it also, by the price action itself, has closed and confirmed that it wants to be better than its moving average 20. We can add to our position now, right? So here you go. Here is the price in relation to its own moving average. Then, how do we collect profits? How do we collect profits? We use the history. Now we're going to bring up another factor in. See, I wanted to do it step by step so I don't jumble everything up. And I say, if I add it on, where possibly can I start accumulating my profits? One of the ways to accumulate profits is calculate the, let's say, several days of data on the ATR. We take 3 to 5, 3 ATR, including the signal day, high to low, high to low, high to low, summed up and divided. And from the entry point, put your target profit automatically right there, figuring if the market had a span of the last 3 days, which is our most recent history. Here's another key $1 million tip. Yeah, markets do have history, but you need to be able to apply in practicality, first of all, the most recent history that the market has shown you. Alright, so that's one way of collecting the profit. Second way, we're saying if the markets are historical and they're self-fulfilled prophecy, we probably are going to take this spike out and the part of the long positions are going to be covered before substantial throwback. Okay, so far so good? Are we following? Yes? No questions? Okay, cool. So here's your price in relation to its own history. And indeed, at this point, I really would like to bring up a whiteboard here and show you something because of the market symmetry, what we have just gone through. We've gone through the definition that, hang on, let me make it a little bit. My artwork is not going to go to museum, believe me, guys. But, okay, so here's your sideways market, right? We have a breakout. And we were sideways, we broke below, we broke above, before we actually took off. So as the market travels on the upside and decides to go into a trend, it's going to take out previous spikes wherever they were, and it's going to come into fold initially after having reached that target. Alright? So that's one tip that you could use to cover your positions. Now, secondly, after it retraces, if the markets hold above the MAs, okay, if the markets hold above the MAs, this is a straight line or trend line, but also, could be an image of the moving average, right? If we, after the retracement, hold above the MA, we can then add to our long positions as we accumulate them from as low as possible. We could then add to our long positions on the return to an uptrend. And then we can use the history, if there was a history on the way down, when the markets were traveling down, like so, and we use this swing and identify where possibly was 76.4 retracement on the fib, and we're going to say, at this point, we're going to collect more profit. And we're going to cover. At this point, then, we're going to have to be looking whether the market is going to reverse, go into sideways, go into consolidation. How does it translate, and how can we help ourselves by looking and using the Bollinger Bands, and also using the shorter MA versus the longer MA. Okay, that's the next step. One of the ways we, traditionally technicians do it is they initiate long positions based on the crosses, right? A shorter MA crossing from underneath back into a longer MA, whichever MA they're using. Alright, but if we went somewhere here long, we would have been kicked out with the loss unless we put a stop loss quite far. One of the ways to put a stop loss would have been to measure this swing and put it somewhere below 61.8. But most likely, you're going to be kicked out with the loss. However, another way to initiate long positions is to see where your long MA confirms a trend of the shorter MA, alright? And this would be your shorter MA9 is already up. Okay, on this day, right here, do you see that your moving average 20 is now in confluence? We're looking now at an agreement. We're looking for convergence, confluence of one MA by the other MA. So here's you another $1 million tip. When a shorter MA is being confirmed by a longer MA, and the prices are still closing higher than the moving averages, that's another time for us to initiate long positions. On this move, one more time, so we also call it, based on having put probabilities on our side, we also call it buying dips rather than buying breakouts. We face that all the time on the intraday trading. After initial breakout, we like to wait for a retracement and then enter. And these two moving averages are putting the probabilities on your side that the price is going to go higher. Here's your history, comes right back in. But if you opened along on this day, right, by the time your history comes in, you're out with the profit again. And that's not so bad, especially for this pair. That's not so bad. Okay, so little by little, step by step, we have to identify and remember again that after breakout, overbought. Now, overbought on the oscillators does not necessarily mean sell. Alright? Overbought, as per the Bollinger Band, some people say to me, well, I was afraid to enter into a long because we already were following the band itself and the prices were overextended on the upside. Well, overbought doesn't necessarily mean sell. Alright, however, and every time you could see that the retracement here, basically this several days, 1, 2, 3, 4, was our sideways market. Alright, as long as the prices did not close below the MA and bounced off of it, can you initiate another long? Absolutely, you can initiate another long. Alright? However, on a day like this, here's your next step. The price in relation to the average. The price in relation to the average. This day was almost fully, the whole price action was back within the band. On days like this, when we have, and if I had these bars, the bull bars one color, like let's say green, and the bear bars red, and I would say, okay, this red, a bear bar, is an indication that we are most likely to face a deeper retracement, if not a reversal. Okay, so let me repeat one more time. If we are in a trend and we have a body of a candle or a bar, or the price action itself is back within the band in the opposite direction of the most recent historic trend, we anticipate at least a retracement, if not a reversal. Okay, then, what do you do then? You still go step by step by step. Where do you initiate short positions? We face this factor all the time, and by the way, I was training on it during the Asian session, remembering that trends do not change in the blink of an eye. So, as the trend is trying to change here, chances are huge that you're going to get first bounces. The bulls are not going to give up. Just like we are waiting for the pullback to initiate from the best price level possible a long position, we're going to first see the price hit the MAs. Possibilities of it bouncing off on the first attempt are huge. Therefore, stay out of the market. Do it on every time frame. Okay? If after initial swing against you, let's say you initiated shorts already, you were impatient, you didn't wait for it to hit MA, bounce off, after the swing back against you, you have a trend line with the lower high. The price closes below, it's also a bearish close, right? It's also closing back below moving average 9. You can initiate your shorts at least to moving average 20. Because the way you trade the Bollinger Bands, the prices are like magnets going to be attracted to Bollinger Band moving average 20. Right here at this level, there was a lot of bears who came in only to get kicked out. You've done your analysis, the day was bearish, it closed back below moving average 20, and a lot of the bears had to lick their wounds right here. So the idea is also to initiate as high as possible your short positions, but be patient. Let it work. Let it work. So by this time, if you opened a short position, or even if you don't keep positions overnight, you still have to see the bigger picture, what goes on the day-to-day basis at least. And at least once a week, take a look at the weekly and monthly charts as well. So you do collect the profit. And if you base your profit on the last 3 days average true range, you're fine. You cover, let's say, 50, 75%. You put your stop loss to entry. You project your other target profits, but you're already risk-free. The name of the game to get on the bank's money. Alright? You could also use your swing from here to here, this move. More importantly, this move, remember, the longer the trend, the more stable it is. Whichever it is, to throw your fibs and see where possibly the market could turn based on the fib numbers as well. We use the fibs all the time. And we say, okay, if the market does this, if it is an important move level, a fib level of any of the recent moves, then guess what? I want to be flat by the time it arrives there. Okay? Now, another moving average that I have here, as I said, is a moving average 233. MA 233 is, I use it and we use it in the room in combination now with the MA 312. I have found that moving average 312 works much better to me than 365. That some of the traders who trade on the astronomy, I don't trade on the astronomy, but I believe in cycles, obviously, right? They use 365, I use 312. You're welcome to put it on your chart exponential, and you will see how these two, 233 and 312, filter out the trends. Okay? As the market started turning, step by step, you could have, this was our analysis right here too. As the market starts turning, bounces out of the MA, fails to make new higher highs, we can possibly say we topped out at the moment. The demand is done. We are at supply area ready to turn. We need to look for safer entries. We need to look at the closes, the price closing below the MAs. This was a down day. This was a down day. However, we bounced on both of these days. We bounced off 62. The bulls were not ready to give in. Once your moving average 9 starts turning, okay, this is your safer time to start initiating the shorts because it's following the price action itself. We're already failing to make very high days here. The price action is failing. Alright, therefore MA9 is following it, turning down, and we are finally, okay, the values of the MA in the middle, I had a question. Moving average is all it is a Bollinger Band 20, therefore the moving average is 20. Is that the one you're asking about, Harry? 2 deviations, yes. 2%. Oh, the small lines, okay. Alright, I was explaining it in the beginning of the webinar. Alright, this one is moving average 9. I mean, if you guys want to use 10 and 20 traditionally crossed, I like odd numbers. I like 21 versus 20, right? However, I also like Bollinger Bands. So there is not that much difference between 20 and 21. Not that much. Right? And markets being speculative, we're speculating. We're just putting odds in our favor. We're just bringing it all together and trying to, it's like, again, putting a puzzle together or making a fabulous pie. You gotta have those ingredients. You gotta have good ingredients, and that's exactly what we're doing. So if you have a 10 instead of a 9, that's fine. The envelopes are 1% above and 1% below. And we also have to notice that if the prices are within the envelopes, right, what that means in the market that we are not overbought, we are not oversold, we're ready to break. We're ready to break again. After being within the 1% above and 1% below, right? So before we start overextending ourselves, whether it's on the buy side or on the sell side. Once we came down to 233, we hit it several times before retracing back up, and the bulls who went in long lost it here. On this day, they lost, alright? The price got attracted right back to 233 and we finally closed. Now how does it translate in the longer term? We're looking at this very important swing. This probably, we make, what we do all the time, we make the biggest swing our friend to work with. Whether it's, even if it's a 15-minute chart, we choose something that is within our vision, within our sight. Most recent history on the intraday, biggest swing, okay? Because that was the most stable trend. That, behind that price action stand a lot of traders who were willing to participate in that whole move. Okay, so volatility was there, liquidity was there, and so market being self-fulfilled prophecy, as the trend changes, this should be our guide where possibly we might go from level to level to level. So I still keep, based on this last big swing on the EG, I still keep my fibs. I still keep them. No reason to, get rid of them. We're also looking at the bullish divergence, and technically the price is to return to an uptrend on the euro pound. And if we said we had breakout market, now we're in the sideways market, we're ready to break again. Provided the markets close above, and see, we have a confluence here of everything, 9, 20, 233. Provided the markets close above the moving averages, what are the chances that we will return to this price level? Are the probabilities there or they're not there? Can anybody answer? The period setting for the envelopes is the same as the period of your moving average that you're using. Okay, we have a lot of confluence here. Mike, you said you missed that. My question. We have a lot of confluence of the different moving averages. Longer term, 233 here, 9, 20. Everything is in agreement, right? Okay, we also said that sideways markets alternate with trending markets. They go right back into sideways markets, and they're going to snap back out again. They're going to stretch. Because if you look at it, if you look what you see, the simple chart, all it shows to you that market is like a rubber band. It's mathematical, it's symmetrical to each other, but it also is like a rubber band. It stretches out, okay, until it cannot go anymore between the supply and demand area, and it snaps right back. And your task as a trader is to find out, by understanding all of that, that this snapped back markets are going to follow by breakout markets, then also seeing what is the price in relation to the moving average itself, and understanding the history. Here we go. Finally, we said it. In relation to the moving average, in relation to the history, this is the history. So if we combine all of these pieces of the puzzle together and the market finally closes decisively with an up day above the MA, what are the probabilities we will get up to this level first? Are the probabilities high or low? I guess that's my question. Anybody? High. Thank you. The probabilities are high that the market is going to be attracted to 87.53 then. 50%. Here is your, indeed, here is your probability. Last day was a low day. Am I going to automatically start jumping on the wagon and going buying it, even though I'm above the moving averages? No. I want to see nice participation of bulls. I know that I'm going to break out pretty soon here, so I'm going to be ready. And I know that at this time, I want to at least take partial position off. And if my trend returns here to the upside momentum, picks up the upside momentum, then guess what I'm going to do? I am going to use my good old history as a guide. All right? And then I will take these guys out just not to garbage up my chart. I'm trying to find my fibos. Maybe I can't. I zoomed out so much, and they're just very faint. Okay, we'll leave them on. But what I'm going to do is I'm going to use this swing from here to here as my friend then. Because indeed, if the uptrend resumes, this is going to be my friend to accumulate or cover more of the positions. I understand that as per the longer term history, I will have resistance right here, and I will have resistance right here. And the more factors I can put into agreement, traveling from supply area to supply area, at these supply areas, we don't know what's going to happen. If anybody is going to tell you that they do, they're lying. We don't know. But based on what we have just studied, we know that if it's a retracement, we're going to use, again, our good old trusted MA to bounce off and resume a trend. And we will also, respect market's history. And after we have marked, usually after we mark longer term levels, we take those fibs off and we say, okay, we're now officially in an uptrend, which we're not. But all I'm saying is that once we determined we're in an uptrend, and by the way, from the bullish divergence that we have here, chances are we are. Okay, we're going to resume an uptrend. We bottomed out, especially if we clear back above 50 of the last move, especially if we clear back above 50. But then we're going to throw the fibs from here to here. And if we find the level at which more than one fib number is in confluence, is in agreement, we're going to put those lines on and say, hey, did the market find a lot of resistance and support in that area? And if I'm traveling, is there a lot of support and resistance in this area? Absolutely. This is your history. The market has known this level. And on the way up, it's going to take this out. It's going to take those price levels out and visit them. We talk about it as market revisiting its own history. Provided I start closing back below the MAs and resume a downtrend, can I project my target profits on the short side? Yes, I can. Absolutely. How would I do that? So if my price action is telling me, based on the MA, that the bulls are not getting on the wagon so actively yet, all right? Price comes right back into fold, and I come right back into my channel. Because literally, I am in the channel. If you want to take the history of only last 10 days, then it would be this channel right here. Can you trade a breakout? You can trade a breakout of this channel too. If you trade a buy on the stop, if you put a buy stop at 86.98 at 87, where we just recently made the high, right, to 87.53, how many pips are you going to clear? Not that many until you come to resistance. So you want to start accumulating from as low as possible based on what the dailies are telling you, employing your intraday chart. Can you trade the break on the short side should the prices start closing below their moving averages here? Absolutely, you can. And then the market is going to know this spike here, this all going to be a support. Is this level important? We find common important levels. Absolutely. 1, 2, 3. So if I'm trying to now setting a sell stop position below this swing low, trading the break out of my channel, then this would be my level right here. To say, I want to protect my position here. And I also want to project, if we indeed topped out, then I want to project what my target, for the target profits, possibly, if I wanted to hold on to this trade, and by the way, some of the brokers will pay you overnight interest for holding Euro cable short, then I want to do my expansion, and I want to do it from the last swing high to the last swing low before the markets went into sideways mode at this swing high. And we just projected something, right, which also is a very important fib level from the long term. So is this level important to the market too? Absolutely. It's very important. Very important. 61.8. And then 100% projection is a return to where we started long time ago, our uptrend. So now you guys tell me that the markets are not symmetrical. By the time provided we start traveling below our MAs and we trade, return to the downtrend, and we trade from support to support, if we come right here, we're going to complete 100% of our cycle. I think it's amazing to see that. And every single currency pair, how do I measure the strength of price when approaching a supply area? Very good question. I appreciate that. The strength of the price I measure by switching to a smaller time frame and looking at, on the smaller time frame, how much covering at that. And you're talking about supply, so that would be resistance. So how much short covering of long positions at the supply area? Okay? And I really like that question. That's very good. So let's go to 15 minutes. 15 minutes. So you see your R1. Can you guys see these charts well? Are the colors okay? All colors are seen okay? Yes. Okay, thank you. I appreciate it. This is your supply area. Based on what we have calculated before, let's say for Euro, we come into New York session in the morning. We look at the bigger picture. We look at more important levels. But we are participating intraday. So we had several of our MAs coming into agreement, right? And prices closing back above. We have a rule in the room. If we're trading momentum, we go 15 to 15 from resistance to resistance in the buy and support to support in the short before we cover and protect our position. All right. So if we initiated a position as per the cross and price is closing, we look for 10 to 15 on the initial, after the spread or after the commission, after on the initial move. Okay. It also has to be during high liquidity hours. High liquidity hours. This is your Asian open. A lot of times during the Asian session, ranges are just being established. The strength is not there. The liquidity is not there. Not enough participants to drive it a bit higher. Okay. Even though it was a winning position, the short covering of the long positions at resistance was just as strong, right? So where would your re-entry be? How do you measure that the bulls are coming back into the picture, which I hope that was the question, the strength of price. You can switch, after the move completed, you can switch to a smaller time frame and see how much of the action is coming from the bears and where the prices end up after that action is done. And we exactly use, again, the fact that the price is, first of all, still closed back above the MAs, right? And we have bulls coming in to possibly bring us up to another resistance level, from resistance to resistance. At the same time, we have the daily swings, fib levels, and market being self-fulfilled prophecy. Other traders see exactly what we see, and they're going to cover. Let's say if it's only 23 or 38, and we are in an uptrend, and we know that at 38.2 of this fib, some of it is going to be covered. But if we start closing below the MAs, we're not going to be looking to initiate long positions anymore. If we have a resumption, just like here, chances are that more bulls will be jumping on the wagon to drive it up to 50. We're just imagining that it could be 50, we don't know at this point, but we do it every morning. And Linda is here, Russ and Peggy, Michael was in the room. We do it every morning. So the strength will be there, provided the price is still kept above or below, above in this case, we are talking about buying, above the moving averages, after retracement, for bulls to still sustain their positions to more important fib levels. Yes. Gary's here. Hey, Gary. Yeah, like I said, I think by now you guys would be sick and tired of my voice. Very good questions. Anybody else? You can start. I think we have about 19 minutes. You can put more questions in. Okay, so right here, I wanted to bring up dollar yen. And this is the price in relation to the moving average and the price in relation to its history, and the market being mathematics. We had this chart built with you guys about a month ago for those who I have it more detailed on my other computer. I am in transition right now. I'm not in my office. I'm working on, I'm in transition, so please bear with me. But anyway, so here's your price action, and what we're talking about is identifying a trend. For us, so far, for the dollar yen, this has been our trend. This is our friend. All these waves here, impulsive, corrective, all these waves are still the waves within the last significant move. And that's very important to remember. And so I keep my fib levels, and I also build a mathematical grid following the waves, the price action, right, which forms support, resistances. They're nothing more than support and resistance, and they can even project, provided the market travels here, okay, at which time point we're going to be at 38.2 and closes. We've tried to close back above. We couldn't. Okay, went back down to 61.8. This is our second attempt to return at 50, return to the uptrend. Okay, from 50, one of the target profits on the upside would be 95.60. Why? Because this is a strong rollover point on any long-term MA, serves as a strong dynamic resistance and support. And provided the market on the second attempt, remember we said if the trends turn, they don't really turn in the blink of an eye. The first time it was rejected at 50. Second time with a high low and a bullish day, it looks like we're then going to travel to right around 95.60. And we can even project when, just by simply drawing the trend line. Okay, so at this time, I want to still trade intraday, because I'm still not out of the woods for the downtrend. I'm going to trade intraday based on what I see, what my bigger picture is showing me. So to successfully trade this currency, then you have your daily, identify what you're looking for. All right, you bring up your 4-hour and the 15-minute. That's what we use. We use a smaller time frame for re-entries to build into position, but we do not use anything less than 15 minutes to enter in. Okay, hang on. Let me bring the dollar yen intraday. And you could see as we bounced off of 61.8, the bulls were not so eager to start buying. The strength came in once we started clearing previous resistance, okay, coming back up to 50, some of it was covered, and so this is the second attempt at higher levels. We said 62 is at 95.60. Let's see if we have any resistance in 95.60, and here we go. Our R5 is 95.60. We didn't take it, out of the blue. This is something where, the strength is not going to be there for the bulls. They're going to be covering their longs. The idea was to start initiating as soon as possible, as low as possible. And after retracement, look for continuing strength in the trend. Could you tell us the settings for the envelope and the MAs used? Sure. You're awesome, though. Thank you. Well, we can analyze EURUSD, that's for sure. We already broke. 42.90, I believe, was in the cards. 43.50 was the previous swing high, and the projection, one of the projections is 45.60. However, fundamentally, I'm not so sure I'm going to keep the positions beyond 45.60. Okay. The settings for the envelopes and the MAs used. Okay. We'll analyze EURUSD. Very good question. Wow. So there's a lot of analysis here, guys. Alright, so we have, the shortest MA we have is 9. Okay. It is simple based on close. The envelopes are simple, of course, also 9. The envelopes are going to follow the moving average you're choosing to work with. Simple, 9, and deviation 1 above and 1 below. So the next one we said that I like using 921, but again, I also really like the presence of the Bollinger Bands on my chart. And so therefore I'm choosing 20 to work with. This is standard. And the stochastic's 3433. Did that help? Oh, there is Mike, that's not very important. There's 0.5 too. 0.5 and 1. So we have just talked about a lot of technicals combining the price action in regards to, the knowledge of and putting probabilities on our side by understanding the price action in regards to its average and in relation to its history. We also brought in the fundamentals. Okay, we also said that it's important to observe the data releases, interest rate, employment, such as non-farm, the trade balance, the GDP, the housing, and understand that if the employment situation is good, most likely the currency is going to strengthen. If an interest rate is high, most likely the currency is going to strengthen. If the GDP is high, the high GDP in return will dictate higher interest rates, which is better for the currency, and that's all that drives the price, and the price is the king. But we do need to understand the fundamentals, that's for sure. Okay, let's go into EURUSD. Let's see if there's any other questions. No, Lee, do you use the oscillators to only show divergence, or can we use it for anything else? Yes, you can use it for anything else. Some traders, they swear that once the oscillator comes out from 80, above 80, crosses back down below 80. In fact, I'm not so big on the oscillators. I use them for guidance and divergences. Yes, I do. However, the proper setup would be to have like a visual line here at 80 and another one at 20. Hang on just a second. Oh, just like right here. And some of the traders swear that if it is in the overbought, by the time it crosses back down, they're ready to buy. Alright, then what do we do here? Right? So, now some of them, of course, use the 50 line, like an RSI and CCI, they use the 50 line to identify where the rollover between the bulls and the bears is. Yep. And that's it. These are all lagging. They will help us, but they all lag the price. Okay, EURUSD daily. I have only 8 minutes. I wanted to talk about a little bit more about shorter moving averages being confirmed by longer moving average to trade trend resumption. And I had another question too. Where did I learn my trading? Are the MA the main entry trigger? Kwanda, do I pronounce it correctly? No, they're not. Not the MAs themselves. The price, the patterns, the fundamentals, the closes, right? The closes in regards to MAs we were talking about. Just remember, we are speculators. Right? And all we can do is put as many probabilities on our side as possible. And that's exactly what we're doing by entering in based on the price in relation to the history, the average. We combine it with the patterns, we combine it with the fibs, and we go from there. For me, the most important level is 50. That's all. I do not use any MA in particular is more important than others. It just depends on what trend do I look at. Do I look to establish or work within a longer term trend? And that's what I actually was going to talk about right now is in a particular situation, let's say if you trade the trend resumptions, your longer MA, whichever it is, in my case it's 50, is going to be the key MA for you to determine. Yes, 50. Yeah. Okay, where did I learn my trading? Which book would you recommend for price patterns? SMA or EMA? Let's take a look at it. Now I have questions. That's pretty good. I like using simple. However, on 62, I use exponential, 233 exponential, 312 exponential. Okay, it brings more weight, and the more exponential, all it does is it exponentially reduces the data, importance of the data, back into the history, okay? And it brings more weight on the more recent historic data. That's all it does, really. That's all it does. So I learned my trading, actually have been trading for 9. The website says for 7, so I think it's going to be adjusted. For 7 years, all I was doing is I was learning everywhere. Everywhere I could. I went to England. I spent, when my friends were going out, I spent time at the libraries studying, and participating. And if you have a mentor who who sells you a system or a service but doesn't participate, run away from that mentor. Here's your divergence right here. There's divergence. A higher price and the lower oscillator as per the swing. Alright, in this case, I have 2 MAs here. 5, both of them are 5, one based on low and one based on high. And I have a moving average 50 determining a longer term trend. In this case, this is my key MA. For this strategy, this is my key moving average. And if a shorter moving average based on lows starts turning, right, that means that we are failing to make turning up in the downtrend in regards to our longer term trend, starts turning up. That means that we're failing to make new lower lows. At the same time, the moving average 5 based on high is following the highs and turning. Now, if the price returns to the previous swing low, provided that your longer MA is still down, could you possibly trade a resumption? Hang on just 1 second. Could you possibly trend the resumption of the downtrend, provided your more stable trend is indeed down? Yes. Okay, now what looked like an uptrend still got rejected by the longer term MA, and if the price ever, and never say never in Forex markets, because the prices are going to revisit certain levels, in which fashion, this is for us to determine, but if the price returns to this low right here, could we possibly say we want to sell on the stop and participate again as bears? Why not? I gotta prepare for my next webinar. I've been here for about 4 hours, so I gotta prepare for my next webinar. So probably another 5 minutes, that's what I can do. Thank you, Gary. Oh, thank you. Sure, thank you. I'm not that amazing, I just practice. Okay, good. So let's go back. Here's your other turn. Here's 3 days, a set of higher lows. If the price returns to the previous swing low, can we reestablish our shorts? And that's how we determine the strength. That was a very good question. How do you determine the strength at the demand area now? And is it really a demand area in regards to a longer term trend? And if it was before, got rejected, returns to it, chances are we're going to go lower. And if you look just at this segment right here, you could also use, for more probabilities, you could also use your consolidative pattern, a set of lower highs, and coming up on the entry to the previous swing low. And here is your bearish breakout pattern, right here. So moving along, this being EURUSD, let's do the analysis of what possibly we are facing here. I have to zoom out, guys. Sorry. Okay, this was 100%. Alright. I still have, on my longer term chart, I could switch to weekly, but I still have all-time low to all-time high fib levels sitting. Who said that they shouldn't be there? We just determined that history is important, right? So all-time low to all-time high. Now let's zoom back out because I know you're squinting your eyes probably. In regards to our all-time highs, we have just, after a significant fall, we have revisited 38.2. Came down again at the double bottom. I would consider this a double bottom. This is like a quadruple bottom. But anyway, we turned. Once we started closing back above 61.8, our retracement after the close above 61.8 gave us a higher swing and a nice uptrend. Alright, now, at this point right here, you're returning. There is more bulls participating on the return above 138.40, attracted to the previous spike and resistance level where the market failed. Okay, 38.2. Let me put the price level there. Right? So we were saying 43.60 would be our target profit, provided market goes, keeps up above those moving averages. At each supply area, we only have shallow retracements and so on and so forth. So this is important. Okay. We also will work with the last important swing when we had a stable trend present. And we can project, provided we close back above 43.68, what are our other projections here with the fib extension? We can take several swings into consideration. This is a minor swing here. We've already been at 61 on the way up. Okay, we're coming close to 100. Let me zoom in a little bit more. I know it's difficult for you to see. So this is a minor swing. However, on this swing, by magic, we bounced off of 50. Ta-da! So here's your other $1 million tip. Keep that 50 going on your chart. Alright? So, once we did bounce, we reached 61.8. Our next target up is 100. 42.90, 42.80, followed by 43.60. Everybody could still hear me okay? Off to work, Russ. Now, what would be the highest level I would start shorting euro on? If, let's say, we topped out and the close of this day, we're still pushing high, but let's say we topped out and the close of this day and the high of this day would be lower than the previous, which is practically impossible now. So, we would consider this our swing high and this our swing low. On the way down, the close below this area, which is in two levels of confluence of we look for as many agreements as possible. Okay, we might come still down here, bounce off, and produce another leg up. However, and see how much support it had historically at the same level? However, if we start closing below there, I will probably start initiating short positions, and I will go from support to support until the demand area comes into place and the bull strength evaporates, meaning back to 50 first. Alright, once I close the 74.6, but I'm just talking odds. I am not going to keep this measuring in reality because I believe this day will surpass the previous swing high. Below 39.50, I will be shorting more aggressively. Okay, so right now our webinar is over. I have to finish up. I really appreciate. Was it helpful? Yeah. Was it helpful? Okay, good. All right. Thank you. A lot of information, but I try to structure it properly so we don't just jump in, okay, well, let's talk about the moving averages. We talk about moving averages all the time. Okay. You're welcome. Okay, great. You're welcome. Awesome. Awesome, honey. Awesome. Okay, I would need to go for a while. I'd need to go for about 10 minutes. You're welcome, Ruth S. I'm not sure. I'm not sure if the taping even went well. I was not sure what was going on with the recording. I'm hoping it is. Thank you so much, Gary, Linda, Russ, Mike, Peggy, everybody who came in to support me. Alright, I gotta prepare. I really have to take a little break. Maud, thank you. I'll be back. Or do you want us to get ready for the next and then take a break? What do you think? What's better for you, Maud? Okay, 20 minutes. Cool.